Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, we're going into a week where the economic fallout of the global shutdown will really start to bite viciously at the local level. Wall Street ended last week in a sell-off mode, with the S&P 500 down 4.4% on the day on Friday. In the minute-by-minute battles in the liquidity trenches, the New York Fed supplied $67 billion in repo funding on Friday. On Thursday it was $88 billion, and for all of last week it was $609 billion of activity, with the most, that's $206 billion, on Tuesday alone. Some of it is rollover, of course, so it's not all net new, but much of it is. They had to put out a statement earlier saying that they are now up for another $500 billion in ongoing support. And they had to put out yet another statement saying they're going to buy another $100 billion in mortgage-backed securities in the coming week. The New York Stock Exchange dive means asset backings are highly dubious and liquidity has dried right up. There are sellers, many forced, but no buyers without the Fed. Even though the Fed will bail out the largest financial institutions, widespread bankruptcies and closures will be appearing across the whole US as shutdowns spread fast. In Canada, sudden unemployment is at crisis levels. In fact, almost 3% of their entire workforce has lost their employment in the first 3 weeks of March. That's more than 500,000 people. In Australia, landlords are under extreme pressure to give rent relief, possibly up to 6 months deferral of rent payments. It is a development that will unstitch investor returns in residential and commercial property, potentially causing a valuations crash. Australia also raised its debt ceiling by 25% to $800 billion, and their government seems to be announcing economic bailouts every few days. A third one is expected later today. So far, their bailout programs have amounted to 10% of Australian GDP. And locally, the Reserve Bank here has started its own quantitative easing program, also in the amount of 10% of GDP. China, South Korea and Japan all seem to be on top of their outbreaks, even if the West isn't. This should be as big news as the failures, because it probably involves Herculean public health leadership that should be celebrated. In China, big car makers and electronics chips firms are all back working and their supply chains restarting. But that doesn't necessarily mean they'll all survive. Part of that is because international orders are drying up fast. But there are solid signs that China's housing market is recovering. After a February wipeout, sales are up to half the normal rate in the first half of March and rising. The US Treasury 10-year yield is falling again, still on its wild ride. It's now at 0.89%, but that's actually higher than this time last week. And gold has risen $18 over the weekend to be at $1,499 an ounce. And US oil prices are lower again overnight, just under $22.50 a barrel, with the Brent benchmark just on $27 a barrel. These represent another 25% drop in a week as demand growth vanishes, and it's more than halving in 2 weeks. And the Kiwi dollar is starting the week lower at 57.1 US cents. That's only a minor fall from Friday, but it is a 5.8% devaluation in a week. On the cross rates, however, were higher from this time last week at 98.7 Australian cents, and against the euro were softer by more than a cent for the week to 53.1 euro cents. That means our trade-weighted index is now at 64.9 and a 2.9% devaluation in a week. And that has grown to an overall 10% devaluation so far in 2020. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.